In the last video, I showed how to pay off a 30-year mortgage in under 5 years. And I looked at the video analytics and seems like we got very good watch time, 72 views and 10 hours, almost 10 hours of watch time only for 0.003 cents, not even a penny. But we're going to do it again, all for the 0.003 cents. And what are we going to do? We'll pay off a mortgage under 30 years, actually under 5, right? And if you think about it from the bank's point of view, they certainly wouldn't like this because they sell their mortgages after they originate them to another party. And so if they sell them to another party, the other party is looking for a predictable stream of income, which they're not going to get if you pay it off in 3 to 5. And I paid mine off under 2 years and 9 months. But you can never really put that in a title because they say, like, if you put, extreme, outcomes, people are less likely to click because they can't connect with it. It's like saying lose 100 pounds versus lose like 10 to 20. But we're going to do it again anyways. But same scenario, pay off the mortgage in less than 5, and we'll see how it works. So if you don't know what I'm talking about, I just kind of do the same thing over and over again, which is pay off debt using something called the velocity method. And if you don't know what the velocity method is, it's just simply a debt payoff strategy that we renamed from something else because the other name um, was considered to be not compliant by the state of Illinois. That's literally why we use this name. But anyways, I'm sure if we say it 100 times, it'll sound cool. So how do we pay off debt? Okay. First step is creating a budget. So you have your income, your expenses, your leftover checking and savings. And I'm going to tell you something. If I were in this situation and I had all this income and then I had to all go out and I only had $38 left over, I would be sweating bullets, right? Because that's you know, in fact, it'd probably be easier if you only made like $1,000 and then you only had $38 left over rather than 6,000 because it just seems like you have very little margin for error when you make a lot of money and you only have very little left over. Okay. So when we do our budget, we have to just create an expense breakdown and list every single debt that we have. So in this case, it would be 4 credit cards, an auto loan, student loan, and a mortgage. And then on top of that, we have our personal expenses. So things that we would always have to pay for, even if we were debt free, like food, gas, insurance, and all that other good stuff, right? And so the whole goal of this is what would our debt I'm sorry, what would our life be like if we were completely debt free? Would our life get better? If the answer to that is yes, then this will all make sense. If the answer to that is no, then you have an income problem, right? Because let's say you have no money left over, or okay, sorry, you have negative money left over. You get rid of all your debt and you're still in negative, then you would have what Dave Ramsey would call an income problem. Okay. So what we're going to do here is we're going to copy and paste the income and the expenses. And what we're going to show is that if we just simply change the flow of money, you can have a very drastic outcome, like different and very different outcomes. So what we're going to do is show that, hey, we're going to do something a little bit different from the average American, which is we're not going to save money, right? Like saving money is how you don't pay off debt. And that's why there's a big fat zero here. Okay. So what we're going to do is move our debt strategically into something called a line of credit. And we're going to put all of our money into a line of credit, right? That's basically the strategy. Now, I know there are some people, new people out there, because I got this comment like earlier today, and let me just show you right here. Okay. Let me see, newest. Having a hard time figuring out what's happening in your video. I'm struggling to follow along with what's happening, though I did watch it only once, and I don't understand half the lingo. Okay. Yeah, because I'm cramming 8 hours worth of content in 20 minutes, and I'm the only person I know who could do that. Everyone else, you'll be watching videos for 8 hours, and then you might like click, but I'm the only one who could do it in 20. So a lot of concepts that I'm talking about here, like some people don't even know what a line of credit is. And what's a line of credit? It's a financial tool where you can borrow money, pay it back, and use it over and over again, like a credit card, but even better than a credit card. Why? Because you can use it for anything. Like you cannot use a credit card for anything and everything. So if I put my entire paycheck into a credit card, okay, I put my entire paycheck into a credit card. Well, guess what happens? I can't use that credit card to pay the other credit cards or the other loans. That's why we don't use a credit card as a main operating account. That's why we use a line of credit, a personal or home equity line of credit. And a credit card is technically a line of credit because it's revolving, but it's not the line of credit that we want to use as our main operating account. Okay. So what we're going to do is this: we're going to just move some debts into the line of credit. Okay. And then we're going to increase our cash flow. So let me just show you this: 5, 8, 15, 27. And let me show you what happens when we simply move $55,000 worth of credit cards into the line of credit. I'll show you what happens. Okay. Bam, 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 bam. Right. So we literally turned $38.55 into $1,816.05 of cash flow without doing anything. Okay. So this is the part where the average person's mind would probably get blown, but they got to see it over and over again, right? I've heard that a lot of people from a lot of people say something like, "Hey, I didn't get it at first, but man, once I just saw it over and over again, I got it, right? I got it." Okay. All right. So that's what we're gonna do is that we're gonna put all of our paycheck into that line of credit, take our expenses out, rinse and repeat over and over again. But here's the catch, right? If you have very little money left over, is the bank going to give you a free and clear line of credit? The answer to that is no. The answer to that is no, because banks don't lend money to people who need it. And there are people who are not aware of that, even though I say that in pretty much every single video. In fact, look at this Reddit post right here: business loans for 4 months ago. Is it just me, or do banks only want to lend money to people who don't actually need it? And the answer is they don't lend money to people who need it, because people who need money don't pay you back. That's the real reason why they don't lend money to people who need it, right? Remember when you had friends who asked you like, "Hey, I really need to borrow. I need the, I need to borrow this money because I really need it." You know what that means to a bank? Human translator literally means I'm not going to pay you back, right? Because the bank does a gajillion transactions, and I don't know if you knew this about business credit. 90% of business credit applications are fraudulent. So the bank does its best to try to only find that 10% that's an actual real business. I don't know if you knew that or not. Okay. All right. So now is what we're going to do is we're going to put our entire paycheck into that line of credit, take our expenses out, and then rinse and repeat over and over again. And then after every single month, the balance of our line of credit would go down by our cash flow. Now, I actually didn't answer the question. Why are we assuming we have a free and clear line of credit if the bank will not give you one? The answer to that is it's actually easier to understand the concept than if you see what you would call a realistic scenario. In fact, if you take a look here, this is a realistic scenario. $4.10 left over, 22 debts. And I remember when I did this in a live stream, I was there for 1 hour and 30 minutes. 1 hour and 30 minutes. So I don't want to be here for 1 hour and 30 minutes. I go over 8 hours worth of content in under 20. So I want to keep it at that rhythm, at that pace. But if you want to see this, join the 99-cent YouTube channel membership. Okay. Don't be a cheapo. It's only 99 cents. And you will never see any other YouTube channel go over a debt payoff scenario like this. Okay. And I'm calling you out if you can't pay 99 cents for this. Probably paying 99 cents on more on does anything even cost 99 cents these days? Probably not. Remember when they used to have 99-cent soda? Oh my goodness. Or a 99-cent Whopper Jr. Remember when I was a kid, my mom used to take me to Burger King and buy me that crap. I wish she never did that. All right, so now, what we're gonna do is put our entire paycheck into that line, take our expenses out, rinse and repeat over and over again. And so take the previous month's balance, previous month's interest, subtract our cash flow, which is 1816.05. And then what we're going to do is take the average daily balance, multiply it by the interest rate, okay? And then divide by 12. And then you see that every single month, right, you still have to pay the interest. And the interest is pretty much the minimum payment for most lines of credit, but you might have to pay a little bit more. But think about this. You have $6,100 in your paycheck. You put that entire paycheck into the line of credit, you're always going to make the minimum payment, right? You're never going to struggle making the minimum payment, okay? And then just going to copy and paste, and then you see how super simple it is, right? All right, so now we see that in 34 months, we got the whole thing paid off. So 34 months. All right, excellent. All right, so 34 months, and how much was that? That was $50. 55K. So 55K. All right. And then I'm going to go ahead and copy and paste. And then we have the auto loan, student loan, and the mortgage. So we're going to do this right here. So 34, copy and paste. And then so now we have an auto loan, student loan, and a mortgage. And then we're going to follow what we call the cash flow index. Now, I actually didn't explain this. I did explain this a little bit differently today. But there's a certain debt payoff order. And the reason why we use these credit cards first is, first of all, they have the highest interest rates, right? But I'll tell you another way that you can know what debts to pay off. And I like to use something called a cash flow index. So whenever I have people send me their budgets, right, it's not like one or two debts. This one's 22 or 21 or 22. And so I have to use a system that's so easy for me to recognize which debts to pay off that it's just a basic number, right? And I use a cash flow index, okay? So what's the cash flow index? It's basically the statement, I'm sorry, the balance of the debt divided by the monthly payment, okay? And I do this for all of them. This is just a ranking system that you use to know which debts you pay off first. The lower the number, that's the one you want to pay off. The higher the number, that's the one you don't want to pay off, or at least you want to pay off last, okay? Because with this high number, the mortgage is $235,000 and you get this itty bitty amount of cash flow, right? Under $1,000 for $235,000. Are you mad? Right? So that's basically what this is saying, this high cash flow index. So what we're going to do is we're going to just do the same thing here, follow the cash flow index system. We're not necessarily focused on the interest rate, even though the interest rate does affect how much you pay, right? But what we're more focused on is the ratio of the balance to payment. If I move this into a line of credit, how much payment do I get in my cash flow, right? So it's 20 grand for 800 bucks versus 30 grand for 450, okay? So I'm going to move this into a line of credit. So I'm going to go ahead and copy and paste. And then this is going to be plus 20607.15. And then what's my line of credit? I'm sorry, what's my auto loan cash flow that I recover? About 828 bucks. And then we see now our cash flow is over $2,644.08. Okay. All right. So now this is what I'm going to do. So we're going to copy and paste this here. Values minus 2644.8. And then bam, bam. And then 42 months. This was all paid off. 42 months. All right. So this would be 55 plus 45, so it's 100K, right? 100K. And then now we have the student loan and the mortgage, so it's gonna be 42, and then it'll be 0. And then now we only have 29 grand in student loan. So things you have to be careful about the amortized loans is that the longer the term and the lower the interest rate, you don't want to move it into a line of credit. That's a big mistake, right? But if you have, relatively long term, like 10 years, okay, but the interest rate is comparable, it's safe to move it into a line of credit. So there's a little bit of nuance, okay, that you have to think about that most people don't want to think about, right? So we're going to move this 20 grand into a line of credit, 29037.43. And what happens here? Well, we get this extra $464 back in our cash flow. And then now our cash flow is $3,109.23. And so you see that right here, because I did this from the last demonstration. I'm just going to update this. So this would be 3109.23. And then I'm going to go ahead and copy and paste. And then wablam, in 52 months, this was all paid off. Whoa, so quick, right? Hopefully that's not what your woman said. If you're a man, you know what I mean? Anyways, I'm talking about cooking dinner, right? You don't want to use a microwave. You want to use an oven. All right, so now let's just go ahead and do this. So this is going to be 140K. And then this is going to be a mortgage. So a mortgage at 52 months will be 52. Okay. And then that's the 30-year mortgage. Let me just quickly check this right here. Okay. So two options when it comes to paying the 30-year mortgage, which is extra payments, which is the default option that everybody has that nobody does, or you can still use a line of credit, right? And why is it that nobody will overpay a mortgage, or almost nobody? Same reason why almost nobody overpays credit cards, because when you overpay a credit card, you introduce a slight amount of friction in the flow of your money. And so if you have different bills you have to pay, like you know, the auto loan and student loan, you've overpaid your credit card with your entire paycheck, makes it hard for you to really pay your other bills, right? So, but with the line of credit, okay, it's the only tool out there where we can put all of our money in and immediately take it out, and there's no problem, right? That is the only one out there in which that happens. Now, let me say this. Now, even though this is the last debt, it's not going to be a big issue if we use the line of credit or not, right? But I'm talking about when we start from the beginning, the reason why we're able to effectively pay off debt so easily is just we're just putting all our money into one place, right? The line of credit. And if we want to keep that rhythm, okay, until the end, we can certainly do so. Maybe you want to do it that way because you realize, wow, this is really easy. That's one reason why I might do this. Now, if you want to know the secret of doing it with a line of credit, paying off your debt with a line of credit, even if it's low interest rate, like 3, and the line of credit interest rate is 8, you got to do it in small pieces, right? You don't put the entire loan into a line of credit. If you do that, that's a mistake, okay? And I'm going to show you this right here, okay? So let's imagine that with this loan, we're moving it in $6,500 chunks, $6,500 sweeps. You know, you put your paycheck in, it goes to expenses out, line of credit goes to 0, and then you move another 6,500, and you do that over and over again. Now, let me just show you this. There are a group of people out there who say, oh my goodness, you're ruining people's lives to teach them you can use an 8% line of credit to pay off a 3% loan, right? And what I'm going to show you here is whether it's 8% or 1%, yes, the interest rate does matter, but it's almost negligible, right? So if I do, look at this, 8%, paid off in 4.7 years, 16 grand of interest. Okay, well, let's make it into 1%. Oh my goodness, 4.7 years and 15.2 grand. Okay, so like 8 and 1 are almost like a blip on the bank's balance sheet, right? So, but I know there are people out there who think this is the end of the world if you use an 8% line of credit to pay off your 3% debt, right? But, okay, moving an entire loan to a line of credit is a completely different story, right? So if I move this loan into a line of credit, it's 4.9 grand of interest, but if I do 8%, look at that, 50 grand of interest. Okay, so that is the only time where the interest rate matters. Because if you move this entire loan into a line of credit, you only get an itty bitty amount of cash flow, right? Itty bitty amount. Okay. So let me just go back here. All right, so now this is going to be 16.4 grand, 4.7 years. And let me just go here. So this is 0 to be 52 divided by 12 plus 4.7. And then that would be 9.03 years. And then we are debt free. Okay, 9.03 years and we're completely debt free. And you see how easy that is? I did it again. No, I think that's what Britney Spears said. Oops, I did it again. Paid off my mortgage under 30. Actually under 5, right? Bank's not going to like this, okay? All right. Okay, well, that's it for today, folks. Have a great day. It's Career Mentorship, and I'll see you on the next video.